Ladies and gentlemen, welcome to Koehler Group's webinar series. The topic for this series is taking advantage of Hong Kong's business environment. And today we will be speaking about the automatic exchange of information and the implications for Hong Kong businesses. Transparency, international cooperation, and accountability promise to be important themes for the global tax environment in the coming years. Among the most significant legal developments is the standard for automatic exchange of financial accounting information in tax matters, which will begin to take effect in Hong Kong in 2017. This standard enables participating governments to request financial accounting and tax information of overseas tax residents and automatically transmit the data to the residents' home jurisdictions. In this webinar, Duessler, Senior Consultant at Koehler Group's Hong Kong office, will discuss the concept and implementation of this new standard and its likely impact on global business owners and their Hong Kong companies. But before we begin today's presentation, I would just like to make sure that everybody can hear me. So if you would be so kind as clicking on the hand button in the control panel, that will allow me to know that the system is functioning. Please note that with almost all webinars, there's always going to be a level of internet instability or sound instability. Please do stay on the line. We will try to get that fixed as soon as possible once we can. If you are having any sound issues, please note that there are two ways to listen into today's presentation. You have the option of using your mic and speakers on your computer or using a telephone landline. You can choose these functions in the audio section of the control panel. As is typical with all Koehler Group's webinar series, we like to have an interactive Q&A session. So please don't be shy. Submit your questions and comments into the questions section of the control panel. We are recording today's session, and the PDF of the presentation together with the recording will be distributed to all the attendees once the webinar is completed. For those of you that are new to Koehler Group and its webinar series, allow me to introduce who we are. Koehler Group is a CSC company. We have 3 office jurisdictions in Asia, Hong Kong being the head office, followed by a subsidiary in Singapore, and 8 offices located in China. We have approximately 120 professionals that are located throughout our 10 offices, and we offer market entry services as well as outsourcing solutions to foreign investors that are looking to operate and expand their businesses in the Asia-Pacific region. One of our unique advantages is we do speak over 10 languages internally and are able to communicate with our clients in their mother tongue. A little bit about myself. My name is Christina Koehler-Coluccia. I'm a director at Koehler Group, and I will be the moderator for today's session. I've been with the company since 2003 when I relocated to Shanghai to open our very first China office. Since that date, I've been helping foreign investors not only with their market entry, but their expansion within the Chinese territory, and more recently with their expansion into the ASEAN region. I'm co-author of our monthly magazine, which is called ChinaInvest.biz, and if you are interested in subscribing to this complimentary magazine, it can be done so on our homepage in the section entitled ChinaInvest.biz Information Series. Now, without further ado, let me just unmute Dennis so that he can introduce himself and begin today's presentation. Dennis?
Yes, thank you, Christina, for the introduction, and thank you to all attendees for attending today's webinar. My name is Dennis Duessler. I'm a senior consultant in Koehler Group's Hong Kong office, and I advise from here Western clients who want to enter either Hong Kong or Singapore and do business in Asia. Next slide, please, Christina. Yeah, today's agenda for the webinar on automatic exchange of information will be comprised by first some basics, the common reporting standard, how tax residency is determined, which accounts are affected, and between which parties information is exchanged, and what information is exchanged. Before we then go into the Hong Kong specific timeline and what to do if you receive an inquiry and what penalties might await if you receive an inquiry and are not prepared for it. And finally, some possible implications for Hong Kong and other financial centers before we go into recommendations and our usual Q&A session. Next slide, please. Starting off with the Common Reporting Standard. The Common Reporting Standard is the groundwork for automatic exchange of information. Automatic exchange of information is derived from it. And the Common Reporting Standard itself consists of 4 main parts. The first is a Model Competent Authority Agreement, or in short, CAA, which provides the legal framework for automatic exchange of information, and it contains template agreements which jurisdictions might use to put their agreement into wording that they exchange information from now on. Then there is the Common Reporting Standard itself, CRS, which specifies standards and requirements for automatic exchange of information, which is the second part. And then there is commentaries on the CAA and the CRS, the Competent Authority Agreement and the Common Reporting Standard, which elaborate requirements for CAA and CRS further and ensure that there's consistent application over all jurisdictions who are taking part in automatic exchange of information. Finally, there is the CRS XML user guide, which is supposed to give some guidance and some advice to jurisdictions on the application of the automatic exchange of information and related regulations. Next slide, please. So let's start off by defining how tax residency is determined, because this is really what you need to know in order to know where you have to look into regulations. First, this is different for individuals and companies. For individuals, mostly the most defining factor is where the individual spends most of his time. For example, in most cases, it is 183 days or more in one jurisdiction, so over half a year in one jurisdiction usually makes you a tax resident for that given financial year. Sometimes, however, this does not apply or only limited. For example, in case of American citizens who are under FATCA, required to pay tax in the United States irrespective of their place of residence. That does, however, not necessarily mean that they are not also a tax resident in another jurisdiction. For example, under FATCA, they can then discount the taxes they have already paid abroad and pay the rest of the US tax in the US. For companies, the first data that everyone looks at is the place of incorporation. Where is the company registered? But in most cases, this is not how tax residency is determined, even though it is part of it. In most cases, it is the tax authorities look at from where the company is managed and where central control is exercised, mainly where is the management board and where are annual general meetings held. We have some examples for both cases. If we go on the next slide, please. Here are two examples. Example one is for an individual with a UK passport who works in Hong Kong. He or she spends 250 days per year in Hong Kong and the rest of the year in the UK. As you can see, even though he is a UK passport holder, he spends most of his time in Hong Kong and under the double taxation agreement between the UK and Hong Kong. This means that he's a tax resident in Hong Kong for salary tax. Example two is a company, a limited company incorporated in Hong Kong. It has no office or employees in Hong Kong, and all directors live in the UK, and board of director meetings are also held in the UK. Under this premises, the tax residency would be in the UK, even though the company is incorporated in Hong Kong. So you can see that it's not always what you would first think it is. Sometimes tax residency can be a bit more tricky. Next slide, please. For automatic exchange of information, going now into the real topic, so which accounts are affected? I think this is the first question everyone should ask themselves if your account is even affected. So first it is to note that only countries who have signed a comprehensive DTA, a double taxation agreement, or a TIEA, a tax information exchange agreement, are exchanging information mutually. So this does not mean that even though there is no DTA or TIA at the moment, you are completely out of automatic exchange of information, because over 100 countries have now pledged themselves to become a part of it and exchange information among each other. But for now, only countries who already have these ties, these agreements, will exchange information. The affected accounts are first depository accounts, meaning any account you can deposit and withdraw money from. Then custodial accounts, which are accounts that are set up in the name of another beneficiary. So this includes trust accounts, brokerage accounts, and their like. Then specific insurances, for mainly insurances which have a cash payout, like life insurances, but also annuities, for example. And lastly, investments of any kind that yield a cash return. The minimum thresholds at the moment for pre-existing accounts is for individuals over $1 million account balance, and for entities over $250,000 account balance. What balance in this case means, it is the average balance over the year. So it does not necessarily, just because you had one day over $250,000 in your company, does not necessarily mean that you are immediately affected. But these are, of course, these thresholds are mainly for the beginning phase of AEOI. I go more into detail on this later. But first, let's talk about exclusions on possible accounts. It is possible to get an exclusion on automatic exchange of information if your account applies as a dormant account. Accounts are generally considered dormant if there's no transaction within the last 3 years, or the account holder has not communicated with the financial institution of his choice in the last 6 years. And additionally, either of these and an account balance of less than $1,000, so it would at the moment not even fall into the threshold anyway, but this is important to note for the future maybe. So this is if you are excluded. Next slide, please. So now I have a graphic to show you between which parties this information actually exchanged. You see in the middle there's the bank, which is the central part, because the bank has all the information on file. They first, if they don't already have it, they should request information from each of their clients, be it a company or an individual. And in case of a company, they have to go as far as to the ultimate beneficial owners, which is why there's an exchange also between companies and individuals in some level. And the bank has to collect all this information on ultimate beneficial owners, on persons who have private accounts with the bank, and then exchange them with the local tax authority, which in this case is the IRD in Hong Kong, the Inland Revenue Department. The Inland Revenue Department then exchanges automatically all information with respective other tax authorities. In this case, I used the example of Her Majesty's Revenue and Customs in the UK. So there will be an automatic exchange of information between both tax authorities, so they can then see, okay, person A has an account in Hong Kong, which we weren't aware of at this time. Let's take a look at it and see if they missed to pay any taxes. So this is generally how the exchange works. Next slide, please. So what information is actually exchanged? First of all, of course, the personal information on the person or ultimate beneficial owner in case of companies, which includes the name, the address, the tax identification number, and account number, and of course the balances of each account. Furthermore, the name and the identification number of the financial institution, and in terms of depository accounts, also the amount of interest paid on the account, as well as gross amount of dividends paid or received, and gross amount received from sale or redemption of assets. Important to note is especially the last point. So even when an account is closed during a financial period, the information would still be exchanged, the last known information, and it would report the closure date of the account. So even if you're affected, closing the account does not necessarily mean that information is not exchanged when appropriate. Next slide, please. So for Hong Kong, Hong Kong specifically is a second mover in the AEOI initiative. First exchanges are scheduled to happen by 2018, while the UK, which was my previous example, is a first mover, which means they already exchange information since the beginning of 2017. So for Hong Kong, 2017 started the commencement of the identification of new and pre-existing accounts, meaning that information that was not yet complete with the banks have to be completed. And this is scheduled to be finalized by September, when financial institutions have to register with the IRD. In this case, financial institutions, by the way, does not mean only banks. Financial institutions is any institution that deals with money. So companies are just as well financial institutions. And this is not a manual step, so you will not receive a form to register, but your institution will be registered via the banks. Individuals, by the way, is a self-declaration. So you have to declare yourself if you fall into automatic exchange of information, if you have to report your finances abroad, basically. By the fourth quarter of 2017, financial institutions have to submit test data to the IRD. In this case, the banks have to submit test data. And the IRD will then in January 2018 issue an AEOI return to everyone, basically asking them to declare the information themselves. Excuse me. The financial institutions then have to file the completed returns with the IRD by May 2018. This is the implementation deadline that is set. If it will all work according to deadline and as scheduled remains to be seen. Excuse me. Next slide, please, Christina. So what do you do if you receive an inquiry? First, it depends on from whom you receive an inquiry. If you receive it from a bank, this will most likely mean that they ask you to declare information that you either already declared when you first opened your account, or that was missed back then or not necessary to declare back then. So here it is important to note, keep in mind that you receive any request from the bank only with the address you have registered with them. Meaning, for example, if you have a US bank account, which is registered with your US home address, but now you live in Hong Kong, you will receive your bank request at your US address. In terms of the bank form, answer this accurately as possible. There's usually just a request for information that is that needs to be on file. You have no penalties or anything to fear from the bank side. Yeah, if you receive an inquiry from your tax office, that is different. First, I would advise you to check if it actually concerns you, your company, or the corresponding accounts, because this is a new system. It happens all automatically. So I would really advise you to make sure that it actually is you who is affected, or if the system is, you know, a new system, if it works, if it didn't work like it should. Then gather all information about the affected account. Understand which amounts are taxable where, and more importantly, why. If you discover, and I would advise you to involve professional help here, in case of your companies, you can use a service firm like Koehler Group. If you discover that taxes should have been paid but weren't, immediately pay all amounts due plus eventual penalties. It will only get worse if you don't. Because as soon as you get one of these inquiries, you have to disclose anything anyway. If the amounts inquired are not taxable and the AEOI inquiry states they are, outline why they are not and provide the tax law that explains why and explain very detailed and thoroughly why they are not taxable where your tax office thinks they are. Again, seek professional help. These inquiries are not to be taken lightly. Next slide, please. So penalties. So this is basically the reasoning why you shouldn't take them lightly. First, if you fail to comply with the requirements as a financial institution for delivering the due diligence information correctly or accurately, or furnish wrong returns to the IRD or any other tax authority which facilitate effective implementation of AEOI, these are the penalties that Hong Kong imposes. So there's a fine at level 3, which is a maximum of 10,000 Hong Kong dollars plus 500 Hong Kong dollars for every continuing day or part thereof. These penalties don't sound too high. So for bigger organizations, I understand that they don't take them that seriously, maybe. But the most important part comes in the last part. If you willfully make a wrong or misleading return, then you will not only receive the fine, you will also be liable for imprisonment for 6 months, or in terms of an indictment, to a higher fine of 50,000 Hong Kong dollars plus an imprisonment for 3 years. This is all for corporates. Next slide, I will talk about the individuals. Christina, yeah. So for employees or contracted workers or management of a financial institution who make a wrong return without a reasonable excuse or causing to fail to comply with the requirements, there's a fine of 10,000 Hong Kong dollar per personal fine and 500 Hong Kong dollars for every continuing day or part thereof, meaning that the employees themselves will get persecuted. And this, again, is more severe in the second case if they willfully make a wrong return or a fraudulent return. The fine stays here at level 3 for the first case, and that means 10,000 Hong Kong dollars, but an imprisonment of up to 6 months, and on indictment, a higher fine of 50,000 Hong Kong dollars and imprisonment for up to 3 years. It's important to note that these are the penalties Hong Kong suggested for any violation. The AEOI and the Common Reporting Standard do not give out any guidance on penalties, meaning that each jurisdiction can decide by themselves if they want to impose penalties and what kind of penalties they want to impose. So these examples apply for Hong Kong. Your jurisdiction, if it's a different one, might be entirely different. Next slide, please. So possible implications for Hong Kong and other financial centers. First off, we already see this in our daily business, shift from holding companies to operational companies and reduced number of trusts. This will further continue under automatic exchange of information, but we already see it now that the banks are inquiring with companies for more information, basically the first step of AEOI. We already see this happening, that holding companies become less and less, and trusts generally do not really exist anymore, not newly set up ones. And we see on the left side a diagram of a company, an organogram of a company, how it used to be a while ago. So it used to be this structure where Hong Kong usually was the holding company of a China Woofy, and there was a European head office in this case that is not even included because it is not part of the same organization. There was a European company, for example, that was completely independent from the whole Asia structure. And in Asia, they would use Hong Kong as the holding company, which then again leads into two holding companies in my example, because I used two shareholders. And these holding companies were usually jurisdictions where transparency was not given. So in the Seychelles and the Cayman Islands, for example, you could not just look up who is the owner of a company, whereas in Hong Kong you could still find this information. Over these holding companies, sometimes you would even find trusts that then further deceive the real ownership. And finally, you would have the ultimate beneficial owners who would be above that. So there would be this whole structure with the entire goal of reducing the tax as low as possible and making sure that a third party would not be able to find out who is the real owner of the company. Whereas we see currently how it is and how it will be in the future, we see that the European head office usually gets directly involved. It's in the structure, the ultimate beneficial owners over the main business, and then the UK main business will either hold the Hong Kong company if the company does really business in Hong Kong, or even sometimes not even consider Hong Kong anymore and invest directly into China. So we see both cases. It depends on the case what is more useful for you. If you currently have a business overseas and thinking about investing in China, sometimes Hong Kong makes sense to structure in between, sometimes it doesn't. It is a case-by-case basis. Again, I would advise you to seek professional help if you are unsure about your options or just would like to know more. Next slide, please. Other implications for Hong Kong and also for other financial centers all over the world. Hong Kong is not exclusive here. It's increased bank compliance on new account openings and compliance checks on existing accounts. We see this already. Companies receiving forms to declare more information on themselves, information that they might already have submitted a while ago, but needs to be updated. And for new account openings, we definitely see an increase in due diligence, whereas you could open an account in mere days and short weeks in Hong Kong, for example, it now takes 4 to 6 weeks because the banks have to make sure they have all the information on hand before they can risk opening an account. Also, we will see likely an increased network of DTAs and TIEAs worldwide, so double taxation agreements and tax information exchange agreements. This is due to the fact that at the moment, these provide the groundwork for automatic exchange of information. With over 100 countries pledging themselves to exchange information, we will likely see a lot of exchange in DTAs and TIEAs between these countries as well. So to govern the terms of automatic exchange of information. Lastly, automatic exchange of information, of course, only adds and enhances other already existing initiatives to fight global tax evasion and profit shifting, meaning tax evasion on a global scale. For example, BEPS, base erosion profit shifting, which limits transfer pricing and the definition, redefines the definition on permanent establishments worldwide. So automatic exchange of information hits in the same goal, basically. So it is just one of many initiatives to fight global tax evasion. Next slide. We will go into the recommendations. Generally speaking, have all your corporate finance documents in order and know what has to be done and what still needs to be done. This includes having your bank statements in order, having your management accounts up to date, being up to date with audits, just making sure you know exactly what is happening with your company financially. This is a rather basic advice, of course. Every company should already be doing this, but under these new regulations, there should be special attention paid to it in order to not risk penalties or, in the worst case, imprisonment. See if your finances are above the thresholds. This is an advice for the first few months because even though it is not official, I am sure that these thresholds are only there to make life easier for the banks. In the long term, every single account will be exchanged most likely because these thresholds are of course only for existing accounts. New accounts, no matter what, they will be vetted entirely and exchanged entirely, because of course if you open a new account, they cannot know what kind of balance you will infuse into the account. So for existing accounts, see if you're above the threshold. If not, and you're not complying entirely, consider yourself lucky and fix your mistakes while you can, if you have any currently not 100% in order. Make sure you understand which of your profits are taxed in which jurisdiction and why. Basically, be faster than the tax authority. You should know more than them about your account and about your finances. Again, if you're unsure about this, because taxation can be tricky, ask for professional help, seek professional help, and look that you really understand why your profits are taxed in which jurisdiction. Yeah, finally, seek professional help if you're not 100% sure about anything. This really, AEOI is an initiative that really hits into not complying 100%. So with automatic exchange happening, there's no hope for anyone who's not complying that he will not be caught. This will all be dealt with by the tax authorities automatically. So be really sure to comply. Yeah. Next slide. I think we will go already into the Q&A.
Dennis, great. Thanks a lot for the presentation. During the presentation, there were 3 questions that came in. You mentioned that in the Hong Kong data collection on bank accounts, the Hong Kong data collection on bank accounts started in January 2017. Does that mean anyone currently not fully clear about their tax situation or even willfully not paying taxes somewhere, it's already too late for them?
Not necessarily. As I said, they started to collect information on accounts in the beginning of 2017. Like any tax authority would do, they start with the accounts that are most interesting, meaning where the most money potentially can be made for them, which means that if you have not yet received any inquiry from your bank, you are likely either you already have submitted all your information to the bank, so they have all your information on hand, or you're not yet you have not yet been in the field of view, basically in the target, and then you can still change things. But of course, they have the history, so the banks will have the history on hand. It depends. It's a case-by-case thing, depending on your account and what exactly happened. Also, of course, between the jurisdictions, Hong Kong is a second mover, but of course there are jurisdictions that even pledge to join later. So if it's an exchange, for example, between Hong Kong and the jurisdiction that pledged to start on later, you might still have time. It depends on your specific case.
Thanks, Dennis. The second question is, if countries need to have signed a double taxation agreement or tax information exchange agreement before information is exchanged, does that not create loopholes again, as not all jurisdictions have the same network of agreements? I know, for example, with Hong Kong, they've only really just started developing their whole network of DTAs.
Right. Definitely. I mean, there is, in my opinion, as long as not all countries worldwide have the same regulations among each other, there will always be loopholes. In this case, there's no exception. Hong Kong has its network of DTAs, which is, for example, much smaller than Singapore's. So if you currently have a company in Singapore that deals with other countries in Europe, for example, you're much more likely to be immediately affected. So it depends on the country, and as long as there's no comprehensive network for everyone, there are loopholes, but not in the sense that information is exchanged without an agreement before, because there will be either a TIEA, a tax information exchange agreement, or a double taxation agreement. Otherwise, an exchange is not happening. So there will always be, if there is exchange between two jurisdictions, it will always be governed by a document that lays out the groundwork Otherwise, there would also be dispute on very simple questions. For example, where is someone a tax resident in certain cases? Usually, DTAs lay that out very detailed. They have multiple criteria, usually starting with how many days does someone spend in a jurisdiction, up to the point if everything is unclear. Let's say someone spends the exact amount of time in both jurisdictions. In that case, it goes to the next step. And finally, if none of these steps can clear up where tax residency is defined, the tax authorities have to actually manually talk to each other and say, okay, is this my tax resident or is it yours, or how do we assess this case? So these are very simple things that a DTA governs, or TIEA as well, that are necessary before information can be safely exchanged.
Great. Then the last and final question for today is, do you see a risk of sensitive data getting intercepted or breached more easily due to the automation?
Well, I think not necessarily more easily. I think the safety of exchange is the same as for manual exchange. What is different is how easily it could be potentially detected. If an exchange happens entirely automatically, then it might be that someone taps into the data and no one really notices. Whereas with manual exchange, you have a higher chance when real people actually exchange information between, in the name of their respective tax authorities, you have a higher degree of control behind it. Whereas with automatic exchange of information, of course, there's a certain trust you have to have in the systems, in the computer systems behind it. And yeah, I mean, there have not been any cases I know of until now where information has been stolen from an exchange of information between tax authorities, but that doesn't mean that it might not happen ever. So yeah, of course, automation always yields a risk for harder detection.
Great, Dennis. So that was the last question for today. If any of the attendees or registrants have any further questions that might be a little bit more case-specific, as I mentioned, you'll be getting a copy of the PDF, so you'll also be getting a copy of Dennis's contact information. Don't hesitate to reach out to Dennis if you do have any further questions. Last but not least, if you are interested in subscribing to our complimentary magazines or online resources, you can subscribe on our homepage, and you will start receiving that information on a weekly basis. Alternatively, you can also follow us on our social media channels, whether it be LinkedIn, YouTube, or other avenues. We have our final webinar within this webinar series tomorrow, which is a guide on having a successful profits tax exemption claim. If you're interested in subscribing to that webinar because you haven't done so yet, then please don't hesitate to do so. You can do so. The link is on our webpage under upcoming webinars. I want to thank everyone for coming today. Thank you, Dennis, for a great presentation, and I look forward to seeing you all again very soon. Thank you, and goodbye.